A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. Interest rate selection. Central bankers believe raising rates works to reduce inflationary pressures by reducing aggregate demand, and lowering rates works to support aggregate demand and increase inflationary pressures. The primary channel for this effect is private sector lending, where higher rates discourage lending and lower rates support lending. We directly challenge this assumption, Mosler and Silippo 2016. First, from close examination of the interest income channels. In the private sector, casually stated, for every dollar borrowed, there is a dollar saved. Therefore, a shift in rates can only shift income between borrowers and savers, as total interest income and expense remains unchanged. Central banks agree with this, and then further assume that the propensities to consume out of interest income differ between borrowers and savers, such that when rates rise, for example, borrowers cut back on their deficit spending to a greater than savers increase their spending. Likewise, as rates fall, they believe that borrowers increase their deficit spending more than savers cut back on their spending. And therefore, central bankers conclude higher rates are contractionary and lower rates expansionary. However, while we agree with the propensity estimates of the central bankers, we further recognize that the state is a net payer of interest to the economy. Higher rates are adding interest income to the economy, and lower rates are removing interest income from the economy. Mosler and Silippo 2016. And with debt to GDP ratios often approximating 100% of GDP, the interest added or subtracted by this channel is likely to dwarf the effect of the differing propensities between private sector borrowers and savers. And in that case, higher rates are in fact an expansionary force, rather than the contractionary force assumed by central bankers. That is, global central bankers have it backwards. They are easing when they believe they are tightening, and tightening when they believe they are easing. And experiences of Japan, the Eurozone, and the US do not contradict this hypothesis, where decades of zero and near zero rates have not triggered aggregate demand or inflation from private sector credit expansions, and to the contrary, seem to be supporting low inflation and low demand.